All right, welcome. Today we're going to go on a quest, not for gold, not for glory, but for something just as valuable, a company's true worth. We're going to peel back the layers and see how the pros look right past all the market noise to figure out what a business is really made of. So where do we even begin?
I mean, that's the million-dollar question, isn't it? You see a stock price flash across your screen, but is that its real value? Well, the short answer is not always. See, that number, that's just the beginning of the story, not the end.
And this right here is the very first clue on our quest. You've got to understand the difference between price and value. The market price, that's what you see. It's right there, it's what you pay. But the intrinsic value, now that's what you're actually getting for your money. That's the treasure analysts are hunting for, an estimate of a company's true worth based on all the cash it's probably going to make in the future.
An analyst's entire job, really, is to find the gap between the price everyone sees and the value that's kind of hidden beneath the surface. But you know, just like in sports, not all players in the same game are created equal.
Think about it like this. Just because two companies are in the same industry, let's say they both make cars, that doesn't mean they're the same business at all. One might be a steady, reliable player, while the other is all about aggressive, risky growth. They're playing a totally different game, and a good analyst needs to understand exactly which game it is. So how do they figure that out?
Well, they don't just guess. They follow a very logical path, a top-down approach. They start way up high with the big picture, the entire economy, then they funnel down to the specific industry, and only then do they finally zoom in on the company itself. Let's start at the top.
So first, an analyst has to look at the big picture. I mean, you wouldn't plan a big outdoor picnic without checking the weather forecast, right? It's the same idea. You just can't analyze a company without first understanding the economic climate it's living in. Is it sunny and growing, or are there some serious storm clouds on the horizon? And to read that economic weather, analysts track key indicators just like these. Is the economy as a whole, the GDP, expanding or shrinking? Are interest rates going up, making it harder for businesses to borrow and grow? Each one of these variables helps paint the picture for the entire market.
So who's in charge of this economic weather? Well, it's largely these two big players. You have the government, which uses fiscal policy. That's things like spending and taxes. And then you have the central bank, which uses monetary policy to control interest rates. Their decisions can create these huge tailwinds that push companies forward, or massive headwinds that hold them back. Think about it. Higher interest rates from the central bank can absolutely slam a construction company by making their loans way more expensive.
Okay, so once we've got a handle on the overall economic climate, it's time to zoom in on the specific playing field, the industry. Is this an industry where companies can actually make money and thrive, or is it more of a brutal arena where even the strongest players struggle just to survive?
A really powerful way to figure this out is by asking a set of critical questions, often called Porter's 5 forces. You ask things like, how fierce is the competition? Can your suppliers just raise prices on you whenever they want? And a big one, how easy is it for some new company to just show up and start stealing your customers? You know, for a commodity like steel, that intense rivalry is usually the biggest deal. But in tech, it might be the power of one single critical supplier that shapes the whole industry. The answers to these questions, they reveal if the industry is a gold mine or a minefield.
And this just perfectly illustrates why that industry analysis is so critical. As Warren Buffett says, even the best managers in the world are going to have a really tough time if they're trying to swim against a strong current in a fundamentally lousy industry.
All right, we've checked the economic weather, we've surveyed the industry arena. Now it's finally time to put the individual company itself under the microscope for a thorough health check. This health check always starts with the company's vital signs, its core financial statements. Think of the balance sheet as a quick snapshot of its health on one particular day. The P&L, or the income statement, that's more like its report card for the last year, showing if it made a profit. But the cash flow statement, that one is the real truth teller.
Why? Because profit is not the same thing as cash. A company can actually report a big profit, but still be running out of money. This statement here, it cuts through all the accounting jargon to show you where the actual real cash came from and where it went. A business that consistently burns through more cash than it brings in, that's like a car with a leaky fuel tank. It might look shiny and new on the outside, but it is not going to get very far. It's a massive red flag for any analyst.
But it's not all about the numbers. A great analyst also has to assess the captains of the ship, the management team. Do they have a winning track record? Is there a smart plan for who takes over in the future? And maybe most importantly, can you trust them? Do they actually do what they say they're going to do?
Strong, honest leadership can be a company's single greatest asset.
So after gathering all of this evidence from the economy, the industry, the financials, and the management, it's finally time for the analyst to act like a judge and jury, to form an investment case and deliver the final verdict.
And this is where a really critical concept comes into play, the margin of safety. It's basically the buffer between what the analyst thinks the company's truly worth, its intrinsic value, and the price the market is offering today. Buying with a big margin of safety is kind of like building a bridge that can hold twice the weight it's ever expected to. It protects you if your calculations are a little bit off or if things just go unexpectedly wrong.
And here it is. This is the aha moment. After all of that work, the entire quest really boils down to this one simple comparison. If your calculated intrinsic value is a lot higher than the market price, then hey, the stock is probably undervalued. But if the market price is way, way above what you think the intrinsic value is, it's likely overvalued. And at the end of the day, the entire purpose of this whole rigorous process is to make this exact decision. It's about using all that carefully gathered intelligence to find companies that are trading for less than they're truly worth and having the discipline to avoid or sell the ones that are not.
So I'll leave you with this one thought. The market is always going to be flashing prices at us, screaming for our attention. But the real story, the real value, is usually hiding just beneath the surface, waiting to be uncovered. The only question is, will you look for it? Thanks for joining me.